Open your favorite finance app or turn on the business news, and you will be hit with a consistent, high-voltage message. Making money in the stock market requires constant vigilance, rapid trading, and staring at screens to find the perfect entry point. Meet Zara. Like millions of everyday investors, she is trying to build her wealth using zero-commission trading apps. And standing right over her shoulder is a loud, invisible companion we all possess: ego. Ego whispers that with enough screen time, Zara can perfectly time the market, dodge the dips, and outsmart the broader economy. Economists Barber and Odin tracked 60,000 retail accounts. While the market returned 17.9% annually, hyperactive traders brought home a significantly lower 11.4%. Why? Constant activity. Households turned over 75% of portfolios. Transaction costs and poor timing act like sandpaper, shaving away potential wealth. The reality of this friction is mathematically brutal. When researchers analyzed the aggregate performance of day traders, they found that more than 8 out of 10 experience net losses. The financial drain is so severe that 75% of all active day traders simply close their accounts and quit within their first 2 years. Our own behavioral biases demand that we take action precisely when the market math strongly favors doing nothing. For the retail investor, the active day trading game functions as a psychological trap that destroys wealth through sheer overactivity. When individual traders finally exhaust themselves, ego usually offers a pivot. Stop doing it yourself and hire the experts. Wall Street is filled with professionals armed with supercomputers, insider algorithms, and Ivy League degrees, waiting to actively manage your money for a premium fee. But there is an objective referee that tracks exactly how these highly paid mutual fund managers perform against a simple, unmanaged market baseline.
It is called the SPIVA scorecard, and the data it provides is devastating to the financial industry. This timeline graph plots the failure rate of active fund managers trying to beat the S&P 500. Over a single year, about 65% of large-cap active managers lose to the index. But watch what happens as the timeline extends to a 15-year horizon. The failure rate steadily climbs, peaking at a massive 89.5%. The active management industry attempts to hide this structural failure using a statistical trick called survivorship bias. Over a 20-year period, nearly 64% among top-tier active equity funds, less than 5% maintain their ranking over a simple 4-year window. Paying for professional active management means betting against a nearly 90% long-term failure rate. For most investors, these premium fees purchase a statistical disadvantage that compounds year after year. Ego will always try to move the goalposts one more time. Average mutual funds might lose, but what about the ultra-wealthy? Surely the exclusive, high-fee hedge funds have outsmarted the system. In 2008, Warren Buffett decided to put that exact theory to the test. He made a $1 million wager against a prominent wealth management firm, betting that a basic, low-cost S&P 500 index fund would beat a hand-picked portfolio of 5 elite hedge funds over a 10-year stretch. This racing chart tracks the competition right from the onset of the global financial crisis. Initially, as the market crashed in 2008, the active managers predictably took an early lead, while the unmanaged index was forced to absorb the full, brutal blow of the recession. But look at the relentless compounding of the index fund over the subsequent 9 years. By the end of 2017, the unmanaged S&P 500 accumulated a massive 125.8% gain, thoroughly crushing the hand-picked hedge funds, which limped to a dismal 22% average. Modern markets have become so saturated with instant information that even legendary investors see their edges vanish. Since 2003, Warren Buffett's annual alpha, his return above the market benchmark, fell to 0.65%, a number the math shows is now statistically indistinguishable from random noise. If the most elite hedge funds and the world's greatest capital allocator struggle to sustain an edge today, the statistical probability of an average manager successfully picking winners has effectively evaporated. To find the real solution, we have to look back to 1976. A man named Jack Bogle looked at the exact same data and realized Wall Street was built to extract wealth, not create it. So he built a radical new product, a fund that completely gave up on guessing winners and simply bought every stock in the entire market. He powered this idea with a mechanical concept called capitalization weighting. It acts like an automated engine. When a company innovates and grows, the machine automatically feeds it more capital. When a company fails, the machine starves it. It functions entirely on autopilot, removing human emotion and guesswork from the equation. This chart shows the mechanical advantage of that automated engine, cost efficiency, known as an expense ratio. By cutting out expensive analysts and hyperactive trading desks, an index fund operates with near-zero friction. We are contrasting the near-frictionless 0.14% fee of an index ETF against the heavy 1% drag of an actively managed fund over 30 years. Because investment returns compound exponentially over time, the fees extracted from those returns also compound exponentially. That seemingly tiny 1% active management fee mathematically multiplies over decades to devour 20 to 30% of an investor's total potential wealth. The empirical data leaves us with 3 clear, actionable takeaways. First, embrace total market simplicity by refusing to play the stock-picking game. Second, fiercely control your investment costs by hunting for the lowest possible expense ratios. And third, buy the entire market and hold it steadfastly through inevitable volatility, prioritizing long-term consistency over high-intensity trading. Wealth generation is the result of letting a frictionless index machine work quietly in the background over decades. This automated approach not only maximizes financial returns by removing fees and behavioral errors, but also returns an investor's most valuable asset, their time.